Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and it is Tuesday the 4th of August. Welcome to Cut to the Chase. Now today I wanted to get a bit more into our views on gold. Last week, many of you might have noticed that we reduced our allocation to gold to a core holding. Now the main rationale for trimming our view was bond yields. In recent months, the correlation between real or net of inflation bond yields and gold has started to tighten once again. This meant that gold faces a stronger headwind from high and rising bond yields. Also, in relative terms, high nominal or real bond yields set a higher bar for gold to beat from a relative return point of view, compounding some of its more short-term challenges. Having said that though, there are also several factors that remain positive for gold, at least in terms of absolute price returns. First, central bank demand remains a key positive for gold as they continue to diversify the composition of their reserves. Recent survey data by the World Gold Council shows that the vast majority of central bankers surveyed expect an increase in gold reserves. A range of data also shows that the larger emerging market central banks continue to actually purchase gold as they seek to diversify reserves. Second, a pause or turn in real bond yields would also support gold. After the Fed's last decision to leave policy rates unchanged, it is more likely that real bond yields are capped or even turn a little bit lower rather than break out to new post-2008 highs. The fact that gold's correlation with real bond yields remains elevated at this time means that bond yields could go from being a headwind to a tailwind in the coming months. And finally, technical signals are also turning a little bit less bearish. We find it interesting that the gold price has largely held a floor around the $3,900 to $4,000 range over the past month. One of my more technically minded colleagues also pointed out that gold recorded its first positive monthly close since March, which also suggests that prices may be stabilizing. So, between all these headwinds and tailwinds, where does that leave us on gold on balance? The conclusion, the bottom line for us, is that we continue to see current levels as attractive to accumulate gold, albeit in line with a core holding. Now, the headwind from higher bond yields does mean that price recovery is likely to be slower than before, which is why we trim our 12-month forecast to $4,600 per ounce. A core holding view, though, does imply about a 4 to 5% allocation across a well-diversified portfolio, depending on your risk profile. This means that current prices likely offer an opportunity for underallocated investors to accumulate a core holding to gold, even if the price and magnitude of recovery is more muted than previously expected. So, that's it for today. Thank you for joining us. We hope you enjoyed this short snippet and we will be back tomorrow with another topic. Thanks for joining and we look forward to speaking with you again.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.